Financial management skills are crucial for both personal and organizational success. They encompass a broad range of competencies from budgeting and financial analysis to investment decision-making and risk management. Mastering these skills enables individuals and businesses to achieve financial stability, make informed decisions, and ensure long-term growth and sustainability. This comprehensive guide delves into the essential financial management skills, providing insights and practical tips for developing and enhancing them. Budgeting and planning. Budgeting is the foundation of financial management. It involves creating a detailed plan to allocate resources efficiently. Effective budgeting requires understanding income and expenses, identifying all sources of income, and categorizing expenses into fixed and variable costs. Setting financial goals is key, establishing short-term and long-term financial objectives to guide budgeting decisions. Creating a budget plan that aligns with financial goals ensures that expenditures do not exceed income. Monitoring and adjusting regularly is crucial, reviewing and adjusting the budget to reflect changes in income, expenses, and financial goals. Financial planning extends beyond budgeting, encompassing the strategic allocation of resources to achieve long-term financial goals. Key components include setting aside an emergency fund to cover unexpected expenses, providing a financial safety net. Debt management involves developing strategies to manage and reduce debt, such as prioritizing high-interest debt and consolidating loans. Savings and investments are essential, allocating resources towards savings and investment opportunities to build wealth over time. Retirement planning is also vital, creating a plan for retirement that includes setting aside funds in retirement accounts and investing in long-term growth assets. Financial analysis and reporting. Understanding and analyzing financial statements is crucial for making informed decisions. Key financial statements include the income statement, which shows revenue, expenses, and profit over a specific period, providing insights into operational performance. The balance sheet provides a snapshot of an organization's assets, liabilities, and equity at a specific point in time, indicating financial health. The cash flow statement tracks cash inflows and outflows from operating, investing, and financing activities, highlighting liquidity and cash management. Ratio analysis involves calculating and interpreting financial ratios to assess performance, profitability, and solvency. Important ratios include liquidity ratios, which measure the ability to meet short-term obligations, such as the current ratio and quick ratio. Profitability ratios assess the ability to generate profit relative to revenue, assets, or equity, like the net profit margin and return on assets. Solvency ratios evaluate long-term financial stability and debt management, including the debt-to-equity ratio and interest coverage ratio. Accurate and timely financial reporting is essential for transparency and accountability. Key practices include adhering to consistent reporting standards, such as generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. Providing detailed and clear reports to stakeholders is important, ensuring comprehensive and understandable financial reports. Regular audits, both internal and external, ensure accuracy and compliance. Investment decision-making. Knowledge of different investment options is essential for making informed investment decisions. Common options include stocks, which are equity investments representing ownership in a company, offering potential for capital appreciation and dividends. Bonds are debt instruments issued by corporations or governments, providing regular interest payments and principal repayment at maturity. Mutual funds are pooled investment funds managed by professionals, offering diversification across various assets. Real estate involves property investments, providing rental income and potential for capital appreciation. Alternative investments include assets such as commodities, hedge funds, and private equity, offering diversification and potential for high returns. Evaluating investment opportunities involves using various appraisal techniques such as net present value, NPV, which calculates the present value of future cash flows minus the initial investment with a positive NPV indicating a profitable investment. The internal rate of return, IRR, determines the discount rate that makes the NPV of an investment zero, with a higher IRR indicating a more attractive investment. The payback period measures the time required to recover the initial investment, with shorter payback periods being preferable. The Profitability Index, PI, is the ratio of the present value of future cash flows to the initial investment, with a PI greater than 1 indicating a good investment. Managing investment risk is crucial for achieving financial stability and growth. Key strategies include diversification, spreading investments across different asset classes, sectors, and geographic regions to reduce risk. Asset allocation involves distributing investments among various asset categories based on risk tolerance, financial goals, and investment horizon. Regular monitoring is essential, continuously reviewing and adjusting the investment portfolio to respond to market changes and performance. Cash flow management. Effective cash flow management ensures that an organization has sufficient liquidity to meet its obligations and invest in growth opportunities. Key aspects include cash flow forecasting, predicting future cash inflows and outflows to plan for periods of surplus or deficit, cash flow optimization, implementing strategies to improve cash flow such as accelerating receivables, delaying payables, and managing inventory efficiently, maintaining liquidity, ensuring access to liquid assets or credit facilities to cover short-term needs. Analyzing cash flow involves examining the cash flow statement and key metrics. Operating cash flow, cash generated from core business operations, indicating the organization's ability to generate sufficient cash to maintain and grow operations. Free cash flow, cash remaining after capital expenditures, representing the funds available for expansion, dividends, or debt repayment. Cash conversion cycle, the time it takes to convert investments in inventory and other resources into cash flows from sales. Risk management. Effective risk management involves identifying potential financial risks that could impact an organization's stability and performance. Common financial risks include market risk, risks arising from changes in market conditions, such as fluctuations in interest rates, exchange rates, and commodity prices. Credit risk, the risk of default by borrowers or counterparties impacting cash flow and profitability. Liquidity risk, the risk of being unable to meet short-term obligations due to insufficient liquid assets. Operational risks stemming from internal processes, systems, and human factors that could disrupt operations. Developing and implementing risk mitigation strategies is essential for minimizing the impact of financial risks. Key strategies include hedging, using financial instruments such as derivatives to offset potential losses from adverse market movements, diversification, spreading investments and business activities across different areas to reduce exposure to any single risk. Insurance, purchasing insurance policies to protect against specific risks such as property damage, liability, or business interruption. Contingency planning, preparing for potential adverse events by developing contingency plans and maintaining emergency funds. Financial decision-making. Effective financial decision-making involves using structured frameworks and tools to evaluate options and make informed choices. Common frameworks include cost-benefit analysis, comparing the costs and benefits of different options to determine the most advantageous choice. Break-even analysis, calculating the point at which total revenue equals total costs, helping to evaluate the feasibility of new projects or pricing strategies. Sensitivity analysis, assessing how changes in key variables impact financial outcomes, aiding in understanding the robustness of decisions. Financial decision-making should also consider ethical implications and align with the organization's values and social responsibilities. Key considerations include transparency, ensuring that financial decisions are made transparently and communicated clearly to stakeholders. Integrity, upholding ethical standards and avoiding conflicts of interest or fraudulent activities. Social responsibility, considering the broader impact of financial decisions on society and the environment. And developing and mastering financial management skills is essential for achieving personal and organizational financial success. By focusing on budgeting and planning, financial analysis and reporting, investment decision-making, cash flow management, risk management, and ethical decision-making, individuals and businesses can build a solid foundation for long-term financial stability and growth. Continual learning and adaptation to evolving financial landscapes, along with leveraging advanced tools and technologies, will further enhance these skills. As financial management continues to play a critical role in strategic decision-making, the ability to navigate complex financial environments with confidence and competence will remain a key differentiator for success.